Hello, my name is Thomas Key, and I am the creator and the manager of the Let's strategy. As of the second quarter of 2016, HedgeCo ranked the Let's strategy the #1 performing strategy on the market. Let's talk about it. Let's stands for Leveraged ETF Trading Strategy. But keep in mind that this strategy is never actually leveraged. We're not using margin to leverage our portfolio. Instead, the underlying ETFs that we trade are themselves leveraged ETFs. We trade double ETFs for the market. This is considered an aggressive trading strategy because not only of what we're trading, but also in the way that we're trading it. So keep that in mind. Also understand that margin is required for this strategy, but not to leverage the portfolio. Instead, we use margin for same-day settlement. It's an actively traded strategy. It's, however, an actively trading strategy that can also be used in IRAs and other qualified accounts. In fact, I think it's great for an IRA account. Disclaimers need to be made, so let's get that over with. Past performance is no guarantee of future results. Investing in the stock market involves a high degree of risk, financial losses are a real possibility, and there is no guarantee or insurance. Therefore, this is not suitable for everyone. Consult with your personal financial advisors before making any decisions to invest. This presentation is for informational purposes only, and it should not be construed as a solicitation to invest or an offering memorandum. We do not support or refute the findings of third parties in their evaluation of the performance, methodology, or attributes of our strategies. Here's the outline of our presentation today. First, an introduction. Then, I'm going to talk about two complementary strategies. We're going to talk about diversification and allocation, and then our method of compounding. And that leads right into cost basis improvement techniques that we use in the Let's strategy. The most important thing, what can it do for you? We're going to address that. And I'm also going to share with you how you can watch it live before actually making an investment into the strategy. That's a very, very special characteristic. We offer a way for you to watch it before you invest in it. I manage the Let's strategy through Equity Logic. That's an investment advisor that I own. But the performance numbers that you're going to see in this presentation are calculated either by Interactive Brokers, which is where I manage the money, or by hedgeco.net, which is a third party that evaluates hedge funds and SMAs. Now, it's important to recognize that the Let's strategy is managed in SMA format. SMA stands for Separately Managed Account. It is not a fund, but it's operated in a way that's very similar to funds in that all of the clients that are invested in the strategy get fills at the exact same price, and they are traded as a group. But the money is never commingled, and that means that it's always in your account. You can always see what's going on. You can see the trades that were made, and you can do this 24 hours a day, 7 days a week, just like you can with your current brokerage account. According to HedgeCo, based on their evaluation of all of the other hedge funds and SMA accounts that they observe, we ranked #1 at the end of the second quarter of 2016 with performance results of 118.29%. In addition, I offer the Let's strategy in a do-it-yourself format through Stock Traders Daily. At Stock Traders Daily, you can also watch it live before actually investing any money into the strategy. So keep in mind, you can either do it yourself, you can have it managed for you, and you can also watch it live before making any decisions to do either of those. Stock Traders Daily is where you can watch it live or do it yourself. So the Let's strategy is a proactive strategy that integrates cost basis improvement techniques with an underlying bias on market direction to reduce risks and enhance performance regardless of market direction using market-based ETFs that are opposite each other, like UCO and SCO might be, or QLD and QID. For example, we began this year, 2016, with a long bias in oil. That means that we were buying primarily UCO, and that's primarily what we wanted to hold. But from time to time, we swapped from UCO to SCO, which is the double short for the WTI trade. And we did that from time to time to improve cost basis in our UCO position. The LET strategy is appropriate for clients who are interested in proactive strategies with integrated risk controls that are capable of making money in any market environment. I'll give you an example. Assume Mr. Jones has a $400,000 IRA. He wants to improve his results, but he may not trust the stock market. He may also think that valuations are stretched. Or maybe he just wants to complement other investments that he has. Well, we can integrate the LETS strategy for Mr. Jones to help him realize his objectives. Helping a client achieve his objectives is not as simple as putting all of his money into one strategy. In fact, when a client comes to me, I usually encourage him to diversify amongst strategies. And there are 3 of them that I offer at Equity Logic. It's important at this time to talk about them. They are the LETS strategy, the core portfolio strategy, and the sentiment table strategy. These 3, in my opinion, can provide an exceptional balance with strategy diversification to reduce risk. For example, let's assume Mr. Jones has a $400,000 IRA and he has a pretty good tolerance for risk. Well, $200,000 might go into the core portfolio strategy, $100,000 into LETS, and $100,000 into the sentiment table strategy, respectively. Let's talk about these a little bit. The core portfolio strategy is designed to replace buy and hold portfolios. Its objective is to beat the market by 8 to 10% annually on average every year with low volatility. I know that doesn't sound exciting, but think about that for a second. Assume that you got fully invested in December of 2007, right before the market crashed in 2008. Let's also assume that you beat the market by 9% every year thereafter. Yeah, in 2008 you got hit square in the face. But by the end of 2009, you were already making money, where it took everybody else 4 additional years to get to break even. That's big. And if you add in all of the years between then and now, you'd be beating the market by 72% today. Yeah, I know it's not exciting at first glance, but the core portfolio strategy has teeth. It's for the conservative portion of a client's portfolio, and it's designed to replace buy and hold strategies. Let's use this example. Mr. Jones has a $2,000 mutual fund that largely tracks the market. He wants to protect it against market decline. But he's not sure if the market's going to fall. And he doesn't want to sell everything because he might have tax consequences, or maybe he needs the dividends from his investment to live. But one thing's for sure, he does not want to experience 2008 all over again either. But we can integrate the core strategy for Mr. Jones to help him realize his objectives. That means when overbought market conditions exist, we will neutralize his portfolio against decline, and we'll do it without selling his core portfolio positions. Interestingly, this also creates a reinvestment plan. In our example, we leave core portfolio positions intact and simply neutralize them against market decline using leveraged inverse ETFs when overbought market conditions exist. And then, when those conditions dissolve, when the overbought condition dissolves, we sell those ETFs. This happens about 8 times per year, but when it happens, we can also take the proceeds from those hedges and reinvest them back into our core portfolio positions. And that adds up significantly over time as well. Now let's talk about our other proactive strategy. That is the sentiment table strategy. Now, where the core portfolio strategy is designed to replace buy and hold portfolios, The sentiment table strategy, just like the Let's strategy, is designed to complement core portfolios. The sentiment table strategy is a rules-based proactive strategy that seeks short-term gains by initiating contrarian trades after near-term overbought or oversold market conditions exist. It trades infrequently, and it is often in cash for very long periods of time. Here's an example of what we do. If an overbought condition exists, we will buy QID, or the inverse leveraged ETF for the NASDAQ. But if oversold conditions exist, we'll buy QLD, the leveraged ETF for the NASDAQ, with the objective of securing a short-term gain. And after trades are closed, we often sit in cash and we wait for the next signal to come. So we need to be patient in this strategy. It's designed for clients who are interested in proactive strategies that trade infrequently, ones that integrate cash as an investment, but also ones that can make money in any market environment. Using the $400,000 IRA as an example, we can help him reduce his overall portfolio volatility by reducing his constant exposure to the market and integrate the sentiment table strategy for him too. It's also interesting to note that our sentiment table strategy was ranked number 5 by HedgeCo in calendar 2015 with a 70.5% return. It did that on only 21 trades though, and we were in cash for 68% of the time. Our efficiency trumped any of those other competing strategies, and in fact, I think that our sentiment table strategy was actually the number 1 performing strategy on the market last year, given the way that we did it. 68% in cash. That's a long time, but we still returned 70% to our investors. Now let's take a look at these 3 strategies and their relative attributes. First of all, we're going to look at volatility, risk control, and our expected return for the Let's strategy, sentiment table strategy, and the core portfolio strategy, respectively. Volatility. The volatility in the Let's strategy is expected to be high. The sentiment table strategy is going to have high degrees of volatility when it's invested, but it's not invested all the time. So volatility is periodic. The core portfolio strategy is expected to have low relative degrees of volatility. The risk control. Let's has a swapping technique, as we'll talk about coming up soon. The sentiment table strategy uses cash to control risk, and the core portfolio strategy neutralizes core portfolio holdings when overbought market conditions exist. The expected returns from Let's and the sentiment table, they're both high. For the core portfolio strategy, we're looking to beat the S&P 500 by between 8 and 10%, but that doesn't mean we won't lose money. That could happen. These strategy attributes can help you determine proper strategy diversification when considering what we do at Equity Logic. But please don't make any mistake here. The Let's strategy and our sentiment table strategy are satellite strategies, and the core portfolio strategy is where most of the money goes usually. Keep that in mind as we continue to discuss this. But on that note, was it really all of these strategies that you came here to learn about? I don't think so. I think you came here to learn about the number 1 strategy on the market year to date, and that's our Let's strategy. So let's get to it. We are changing the way people think about compounding returns. We're not traditional. We're changing the way people think, and our performance sets us apart from everybody else. The performance of our Let's strategy this year is remarkable, and, I might add, pretty darn clean. But we're not perfect. We do have drawdowns. So don't think that this strategy is without occasional drawdowns. Drawdowns do exist. But still, we're doing very well. In fact, our alpha is over 13. Granted, our beta is high too, but you would expect that with an alpha of over 13. Our performance characteristics versus the S&P 500, exceptional. As are our risk measures. I might add that HedgeCo is evaluating these on a monthly basis. Interactive Brokers provides this on a daily basis, so we'll compare them. But on a monthly basis, our Sortino ratio is 198. That's ridiculous. On a risk-adjusted basis, the Let's strategy, although it does have drawdowns from time to time, is doing remarkable. On a daily basis, our risk-adjusted performance measures aren't bad either. In fact, our Sharpe ratio is 4.34, Sortino 7.53, Calmar ratio is 137. These are great numbers. Also, however, this better identifies drawdowns. And we have had a drawdown, right? They do exist, and they're going to exist again in the future. But our recovery took 14 days. We snapped back after experiencing that drawdown. At the time this particular performance characteristic was measured, the S&P 500 was still under where it was at its relative peak. The risk-adjusted performance metrics for our Let's strategy are exceptional. And if you were invested in this strategy, you would have a very clean monthly looking chart. We're up 118% year to date as of the end of the second quarter of 2016. Now, as I said at the beginning, you can watch Let's live through Stock Traders Daily, and I manage it actively through Equity Logic. Both of these use the same process. So let's talk about how it works. First of all, there are only 3 trading instruments that we use in the Let's strategy: cash and 2 ETFs. One is a long ETF and one is a short ETF, but both are leveraged ETFs. So cash and a double long ETF and a double short ETF. Here's some examples. Maybe it's cash and QID or QLD. Maybe it's cash and DDM and DXD. Maybe it's cash and UWM and TWM. Maybe it's cash and SSO and SDS. Maybe it's cash and UCO and SCO. It depends on what market it is that we're watching. The second step is to have a point of view. Have an opinion about direction. For example, let's assume that we expected the market to fall. Our observations, whatever it is that we used, told us that the potential for market decline was high. So we had an underlying bias that the market would fall. Then we need to select the market that we're interested in trading. Let's assume that we decided on the NASDAQ. So we expected the NASDAQ to fall. In summary, our opinion is that the market is likely to fall. Our market selection was the NASDAQ 100, and our trading tools were cash, QID, and QLD. After doing that, we're ready to get started. However, let's pause for just a minute and remember, we are not perfect. We're not perfect, and we should not expect to be perfect. We're going to make mistakes. We're going to initiate these positions, often I would say, at times that aren't opportune. But that's okay. because our methods help us improve cost basis. And all we have to do is stick to them. Let's talk about what they are. First things first, we need to initiate the trade. In this case, it would be to buy QID. Once we do, we can start using the techniques that differentiate us. We are now invested in QID with the underlying bias that the market is poised to fall. Our trading instruments are QID, QLD, and cash. Off we go. We are differentiated by our swapping techniques. They're designed to improve our performance. But our mentality is actually to improve cost basis in our original position. In this case, in our QID position. What we're basically doing when we do this is transitioning from QID to cash to QLD, back to cash, and back into QID. It's a rotation. It's basically all it is. The cash positions are held for very short periods of time, 5 seconds, 10 seconds, as we transition from QID to QLD, for example, or back to QID from QLD. But our underlying bias is that the market will fall, so our intention is to hold QID primarily. It doesn't always happen. Sometimes we need to hold QLD for longer than we might otherwise. But our underlying bias is down, so QID is our primary position. Now I know this sounds like a back and forth type of an approach, but it's calculated, it's very machine-like, and it's extremely powerful. Consider this. We all know what compound annual growth rate is, CAGR. We've heard about that many, many times. Some people even talk about compounded monthly growth rate, the growth that you get by compounding returns on a monthly basis. Well, you know what? We do this every time we engage in a swap. Every time we move from QID to QLD to back to QID, our compounded growth rate per swap happens every time we do that. We might make 2 of these in a week, maybe more than 2 in a week. Compound annual growth rates look archaic compared to what we're doing here. We're turning that whole perception on its head. But it only works because we're keeping it simple from the beginning. This is the most important thing about this strategy. We're reducing the noise, reducing our emotions, and reducing the time that might be spent trying to evaluate what's happening with the competition for Apple or the competition for Google or whatever other individual stock we might be considering. All we're trading is QID, QLD, and cash. None of that other stuff matters. Because of the simplicity of our approach, we can focus on what matters most and improve our efficiencies and our effectiveness. It's the most important thing. Keep it simple. Now, before I go on, let's do a little quiz. Here's some assumptions. Assume that QID is $30 per share. Assume that QLD is $70 per share. Assume, like we've discussed, that our primary position is QID, so we have a short bias. Let's also assume that there's an opportunity to improve cost basis in our QID position. So we swap to QLD from QID. The question is, given those assumptions, how much of a gain do we need from QLD to improve our cost basis in QID by 1%? Here's the answer. First of all, let's illustrate a couple of the facts. QID and QLD are direct inverses. That means for every 1% gained in QID, QLD will lose 1%. Now this is especially true on a daily basis. Sometimes it diverges a little bit if you look out months and months and months, but it's pretty darn exact on a daily basis. If QLD increases, gains will be realized given the assumptions that we made in the previous slide. In addition, if QID declines, we can also buy it back at a lower price given the assumptions in the previous slide. The cost basis improvement is therefore doubled every time we do this, where a 1% gain in QLD equals a 2% cost basis improvement, assuming the swap back is on par. Think about that. If QLD increases by 1% and QID declines by 1%, our cost basis actually is 2%, assuming that we get back in at the same relative price as where we sold the QLD position. So the answer is, at about 35 cents, or 0.5% gain in QLD, we will have a 1% cost basis improvement in our QID position. Let's take that a little further, because there's a bonus to this. Compounded growth rates per swap applies here too. So, first of all, we have 0.5% more money from the QLD position. QID is also priced 0.5% less. And this is where the evolution of compounding comes in. We can buy back about 1% more of QID when we swap back to QID2. So we'll own more shares when we do this. Compounded growth rate per swap applies here too. So the benefit is, if QID recovers back to where it was, we made 1% and we own 1% more shares while everyone else is just at break even. Think about that in a broader spectrum, longer time frames, and think how fast that adds up. It's all about consistency, though. You have to be consistent in what you're doing. Think about this. What if you did this every single week? Once a week, that's it. All you needed was 0.5% from QLD. Your cost basis improvement would increase by 52% if you did this one time per week and maintained a net short bias and QID the entire year. In addition to that, if you did that 1% cost basis improvement per week, the market would have to move against you by 26% for you to lose money over the course of a year. The risk management integrated into this strategy is exceptional, but it's not obvious to the naked eye. That cost basis improvement technique, it's an exceptional risk management tool. And although these little bits of cost basis improvement do not seem significant to the naked eye, they are. And they add up fast. But they also help us improve performance once the market starts to move in our favor. And that's where we begin to empower our competitive advantages. We can do this. We can do it better than the big boys can because we're more nimble than they are. We have a significant competitive advantage, and we should be taking advantage of it. So let's use an example of exactly how it's done. I selected a graphic, just another example, because we do this all the time. This is just another in a series of examples. It's one that happened recently, given the time frame in which I prepared this presentation. But again, that QID assumption. Let's assume that we're in QID. Let's assume that QID this time was falling, so it was declining. So we had to play defense. Our goal was to improve cost basis, and our method was to use our swapping technique as we've discussed. First things first, look at the charts. The charts are always going to tell us what to do. In this case, I've identified support 3 times. 1, 2, 3. I've identified support. In this particular case, QID began to break support. And when it did, there was an opportunity to improve cost basis. So the cost basis improvement started at $29.48 on July 7th of 2016. We only needed QID to drop by 15 cents for our 1% cost basis improvement to be realized. It dropped by a lot more than that. So we were able to realize a 1% cost basis improvement. Now, it's also important to recognize that for people that are doing this themselves and that are members of Stock Traders Daily, whether you're doing it yourself or you just want to monitor it and watch it live, it really doesn't matter. You're going to get email alerts. If you're engaged in the Managed Money program, we're not going to send you email alerts. You don't need them, right? But for do-it-yourself investors and those people that are watching it live, we send email alerts for subscribers to Stock Traders Daily. And so you can take action and monitor accordingly via those email alerts. However, examples are provided on a regular basis because swaps happen on a regular basis. Compound annual growth rate per swap. It happens all the time. And in fact, in this particular case, just a couple days later, we had another opportunity to improve cost basis because QID continued to fall. Our cost basis improvement this time started at $28.61 on July 8th, the next day. Now we only needed QID to drop by 14 cents again for our 1% cost basis improvement, and it did. It did more than that. So we were able again to improve cost basis by another 1%. In a couple short days, we improved cost basis by 2%, and that's big. But let's add this all up. In this example, in this real-life example that spanned a total of 3 trading days, QID fell from $29.48 to $28.14, which was a 4.5% decline. We identified cost basis improvement opportunities of 1%, 2 times, for a total of a 2% cost basis improvement. These were directly related to our technical observations based on breaks of support. Now, it's clear that we're not making any money in this example, right? But what we did do is offset that 4.5% loss by 2%. So we're actually only down by 2.5% now. And we also own 2% more shares of QID than we did before. So if QID goes back to $29.48, we will be making money while everyone else just gets back to break even. That's very, very important. But on the other side of the fence, if QID continues to decline, we're going to need to continue to play defense. In fact, I need to drive this home. I need to drive this home almost every day, by the way. Defense wins championships. It's plain and simple. So we need to play defense. In fact, this let's strategy is predicated on playing defense in the first place. So just stay calm and play defense. Just stay calm and be consistent. But also recognize that good defense also fosters good offense. Defense turns into offense. but it all starts with a defensive mindset. Keep it simple and stay consistent and stay defensive, and this strategy is going to work for you. Or at least it can, and it has. The Let's strategy is ranked #1 by HedgeCo with 118% return, not because of its offensive mindset, but because of its defensive posturing, in my opinion. The returns wouldn't be the same if we didn't have that defensive mindset. It is all because of the defense. However, the Let's strategy is only part of what I think a portfolio should look like. Most of the money goes into the core portfolio with lower volatility. The Let's strategy, great, #1 year to date. That's excellent. I think some money belongs there. And I think some money also belongs in the sentiment table strategy, which was ranked #5 last year, of course. But I think most money goes into the core portfolio, and the Let's strategy and the sentiment table strategy are satellite strategies accordingly. I think that's very, very important. But I also think that this method of strategy diversification will help most investors achieve their results. So that begs the question, what can this do for you? Well, I think the combination can help you protect your core portfolio. It can help you reduce overall volatility and improve overall performance. And do it by allowing you to empower your competitive advantage. Those big boys, those big hedge fund players, they can't be as nimble as we can. There's no way. They just can't do it. They manage too much money. And as a result, we can make money no matter where the market goes, and we can integrate risk controls and swapping techniques that they cannot do, and we can empower our competitive advantages to improve cost basis better than any of them could hope to do. And in doing that, we can live a much more comfortable lifestyle.